Hey folks, welcome back to Real Estate Investing Unmasked. Today we're going to talk about the current state of affairs in real estate here in the United States. All right, so as you can see, I've got this chart here. This is one I crudely drew up before I did very much research on the very actual charts, which I will show you probably in just a couple of minutes, so stick with me. I first drew this to kind of show the general idea of how things work. As interest rates go down, house prices tend to go up and affordability tends to stay the same. Wages, as they go up and inflation goes up with it, then you also maintain affordability about the same. Right now in the United States, we have a huge house shortage. The house shortage is probably going to last for years and years. Why? Because all the people in the baby boomer era that had babies, my generation, I don't even know what I'm called anymore, Generation X to the millennials, and now all Generation Xers and millennials are having babies, and all those people who were born in the 90s and in the 2000s, the early 2000s, they're all looking to see what can they do to buy something. So anyone that was born in the 90s is definitely looking. Anyone that was born in the early 2000s, they're starting to think about looking. So there has been a glutton of people looking to buy homes. Now, interest rates have come down dramatically. In 2020, if you go back to 2019, one of my videos was showing you that I believed that the real estate market was going to go down in 2020. And the reason for that was the house prices were already very high and the interest rates were low, but the affordability had gone down, in my opinion. Now, in early 2020, when everything stopped and people could move out of their areas, especially people, when you're working from home, a lot of people found affordability go up, spiked. And so that caused house prices to go up even more. But what it also did was it cut down on how many houses were available for sale. See, the people that build the brand new homes, they had to stop building brand new homes because just like everybody else, the whole market stopped. Well, while they were stopping the home building, people were trying to get out of their houses to get an office, someplace they could work remotely, a bigger house, a bigger room, whatever. And the supply was remaining steady. And then as the amount of houses available for sale actually went down, which causes the prices to go up because the amount of people looking for houses increased. It increased dramatically. So a lot of people who'd been living with their parents were now looking for a way to buy their own place. So it's caused a huge difference. Now, recently with the economy opening up, it's also caused another little issue. Now that the economy is opening up, wages are starting to increase. There are actually a lot of people who are offering minimum wage or whatnot that are offering much higher than minimum wage to try to entice people to come back. With the stimulus checks, they provided a lot of money to flow into the economy. Well, at the same time as all that money flowing into the economy, what happened was we had a savings rate. Now, I didn't put the savings rate on here, but the savings rate actually went up dramatically when the stimulus checks came in. Everybody expected people to spend that money right away, and they didn't. Most people did not spend that money right away. Matter of fact, they saved it. And so that's caused the savings rate to increase dramatically, and we have a labor shortage. So right now, house prices are going through the roof, interest rates are going down, inflation has ticked up lately. However, inflation is going to be held on a little tightly from the wages, from people not necessarily getting their jobs or having an increase in wages. People are holding on to those savings. Now, the savings that people have, because it's the highest savings rate that we've had in a long time, eventually that money will enter into the market. And when it does, you're going to find too many dollars going for too few things. So this is the chart that I came up with. Let me show you some other charts that were done by people that get paid to make charts. So these charts are made by people, economists, that, well, they get paid to make these charts. So here we have the source is realestatedecoded.com. The source is Core Logic from the Case Shiller Index. And this is very recent. You can see 2022 here on the bottom. We haven't quite reached there yet, obviously. And this is considering 80% as the mortgage. So here we see this bottom line in red. That represents the payment price, your mortgage, inflation adjusted. So what that tells me is affordability, like I was showing you before, essentially stays the same. Right now, the affordability has remained the same for the last couple years. This is including 2020 and part of 2021. The cash price, the equivalent of the price, has actually gone up dramatically. Remember, this is inflation adjusted. So these prices are very high However, we can afford them. Why? Because the interest rates are low. So here's the real cash price when you figure in a couple of other factors. It doesn't matter. The main thing is the price, the amount that people are paying, inflation adjusted, is essentially the same as they've been paying since 1990, when the interest rates were very high, in the 9s all the way up to the 17s. So let's go take a look at the next one. Here, these are the mortgage rates since 2019 to 2021. They're assuming in June and July. This one is from Freddie Mac, and they are suggesting that the interest rates are likely to go up. Now, I bought my house, the most recent house that I bought in December, right down here. So I bought basically at the low of the interest rates. Not everybody did that. Anybody that bought back here a couple years ago should be refinancing, because the rates are going to be the lowest they're ever going to be, most likely. So the rates have come down, which causes affordability to increase, or the payment that you can afford to pay remains the same, but the house price that you can afford goes way up. So as the interest rates go down, the house price can go up and your affordability stays the same. Again, affordability stays the same, house price goes up. All right, the next one. Now, in this one is from 1990 till today. In 2020, this is the sources of 2021 for the market report from Keeping Current Matters. And this is the affordability index. The higher the number, the more affordable the housing. See, in 1990, it was barely affordable for a lot of people, versus now it's very affordable. We are in an interesting market where I have talked about in the past, just in the last couple of months, how there's supposed to be a wave of foreclosures. We'll get to that. Some interesting information has come out since that wave of foreclosure comment from the CFPB. So here in 2007, 2006, when the housing market crashed, if any of you remember that time, the house prices were insane. They were absolutely insane. It was very hard to afford something. So you see here at 108, it's the same as 1990. Here we had interest rates in the 5s, 6s, and 7s. And here we had interest rates in the 9s to 17s. So what happened here that caused these houses to be very affordable is the real estate market crashed. There was way too much supply and not a whole lot of demand. At the same time, the interest rates dropped to try to reignite the economy. So this was the Great Recession right here. So the affordability went skyrocket. You can see here in 2012 was when everything was most affordable. All right, so let's take a look. The next one. This is an interesting one. This is the one with the wages. So here we start in 2000, and we see this is inflationdata.com, is updated last in January of 2021, so this year. And these are the price changes of everything. Now this right here is gasoline. The price of gasoline is the most volatile of all the things that are on here. And the wages, you'll notice the wages have increased slightly over time. So you have wages that have increased, but you have affordability remain the same, right? So this is inflation adjusted. This is not inflation adjusted. This is actual wages going up. Medical care, child care, schooling, college, and hospital bills, those have gone up, while other things have actually remained the same price for a very long time, which means our ability to afford things has increased in new cars, cell phones, software, toys, TVs, and computers. And shelter doesn't mean that the prices went down necessarily, but our ability to afford them has gone up because their prices have remained the same. All right, so the more affordables down here, the less affordables up there. Our wages are there. Let's go to the next. Oh, and just to point out here, shelter, food and beverage, and electricity are utilities, and the things that we live off of have essentially remained with our wages. Oh, this is a crazy one. Okay, so this is the amount of inflation. Now, this one's a crazy graph. You can see it's gone up all over the place. Here in 1989, also from inflationdata.com, from 1989 to 2022, inflation has remained in this area right here. It's been trending down for the longest time. Here at 0%, we actually went into deflation, a deflationary market in 2009, 2010, when the housing market crashed. It has since gone up, and you have a couple of peak inflation moments. Here's where oil peaked. This is the Hurricane Katrina caused a peak, and way back in the 90s, you had a peak of inflation at 6%, 6.29%. So you've had a lot of inflation. Well, right now, as of just a couple weeks ago, we were told that we hit 4.99% for May. That is very high. As you can see now, the Fed has been saying that this is transitory, which means it's temporary. It's not going to last forever. They think it's going to go up and then come back down, and they think they're going to maintain this 2%. That's their target. They think it's going to come back down. Interesting. Here's the monthly inflation. Now these are 3 different colors. There's one you can probably barely see, which is 2019. So it's going like this, inflation, and then down, and then down, and up and down. And then in 2020, you have inflation, and then March and April. April is the lowest. Why? Well, because that's when everybody shut everything down. March and April, everybody was out of work. That's when everybody was panicking, thinking, oh, the world's gonna end or whatnot. Well, in May, we broke even. June, it went back up again. We actually had inflation again. We had, I believe we had a stimulus not too long after this. So we started to see those numbers go up. Now you got deflation in November, inflation in December. Now look at this here, 2021. We did get a stimulus check somewhere around in here, and there was another stimulus right around in here. So you start to see inflation rise. Remember, the savings rate increased dramatically. Not everybody spent their money, but some people did. The other thing is a lot of people, a lot of companies weren't able to get the supplies they needed, so they had to hold on to their inventory. Well, how do you do that? You raise the prices to kind of cut down on how fast you sell, but at the same time you make profit while you're waiting for your stuff to come in. So we have a peak right now of inflation between April and May. It kind of teeters right there. So the question is, what's going to happen from here on? You got some people saying that's going to teeter off and to come back down again and be all nice and dandy. You've got some other people that say it's going to continue on upward, and other people that say it's remain the same. I would say the majority of the people who are in the press are saying it's going to go down. Now, I feel like it's going to remain about the same, if not increase a little bit, and it's going to kind of waver until it can finally correct itself in the end. But I do believe inflation is going to continue to rise, or continue to be high for the foreseeable future, for at least several months, if not more. So this, when I spoke on the CFPB a couple of months ago, they talked about a wave of foreclosures. What has happened? Now this is from January of 2021. A lot of people were in forbearance. Out of the people that were in forbearance, 51% have paid their forbearance. That means they were behind on their mortgages and they brought it back current. That's a good thing. Either paid off their loan, 7.5% did that, 15% were past due, but they brought it current, or they just went ahead and made their monthly payments back during their forbearance period. Now, 13% right here, 13% of these 15 that are still in trouble, they have no plan. They have no plan set up. The 1.9%, they have repayment plans, or they're expecting to sell their property in short sales or deed in lieu of foreclosure. Now, the market has gone nuts, right? If we go back up here to the housing prices have increased dramatically. The last house that I bought was in December, or was in November last year, and the next door neighbor has just sold their property for $50,000 more than what I bought my property for. Now, granted, I bought it under value, so I had some equity built into it. But even at what it appraised for, the neighbor that just sold their house sold it for $35,000 more than what my house appraised for in November. That is an approximate 10% increase, about a 10% increase in value in 7 months. That means in a lot of places we're seeing year over year 20% increases. Some places it's closer to 5 to 6%, but there is a lot of movement bringing those house prices up. Now, from the experts I've listened to, or at least the people that pretend to be experts, the foreseeable future is that the housing market will continue to go up. The people that are in forbearance, the people that have brought their mortgages current, they're no longer in foreclosure. Matter of fact, every single one of these probably has equity in their property. So instead of losing their house, they'll probably just sell it and get a check for the equity that they have in their house. This amount of people, if they all put their houses up for sale immediately, that could cause a little rift in the housing market. But here's what's happened. A lot of the lenders have arranged with the people who have been in forbearance to get out of that. You have loan deferral, you got loan modification, and they're not done yet. This is 33% have worked out a plan with their lenders. And this is only the beginning. The forbearance isn't over, as I understand it, until September, and in some cases, they're trying to push it till December. If that's the case, the lenders that haven't gotten to these guys yet, these 13%, they probably will. Or these guys will end up selling some of it. So I'd probably say about half of those will probably sell, and probably about half of them will end up making a deal with their lenders, because there's just too much equity in there. With the market right now, with how many businesses are trying to hire people back, what I can see happening is what happened similar to, let's see, where's the income, the wages. When Rockefeller was hiring his people back in the early 1900s, what he did was he paid his lower wage people more than all the other people. He refused to pay minimum wage. He actually bumped it up a couple bucks an hour, equivalent to today's dollars. Well, Amazon, McDonald's, a bunch of other companies right now are doing the same thing. They're raising, I think Universal Studios, I haven't heard Disney talk about it, but they're probably doing it too. A lot of companies are pushing to raise how much they're paying their minimum wage employees to be more than minimum wage. Well, what that does, instead of having a minimum wage come up by the government, it actually causes the wages to increase, which causes an inflationary pressure, because all the things that we buy, the food, the electricity, the shelter, that have remained with wages will probably remain with the wages, which causes all these other things to start to tick up. Okay, so I do see, in my opinion, I think the housing market is going to continue to go up. It has historically gone up about a 6.5% over the last about 10 years or so, 6.5% per year. On the long end of things, it's closer to about 4% or so, but I can see, based on the numbers and information I see, my opinion is that we're gonna see these house prices keep on going up through the roof. So if I was in a situation where I could buy a house this year and I was gonna hold on to it long term, I probably would. I bought one just last year, just 7 months ago, and it's already got 20% equity in it. I only put 5% down. It's amazing. So if you're looking to buy, you probably want to buy sooner than later, is my opinion. Go seek out financial advice for yourself. If you're looking to sell, you could either sell now and buy something else. If you have a second house, it'd be a good time to sell. But rents are also going up, because as people buy these houses, the amount that they're paying every month, while the affordability inflation adjusted remains the same, the amount that they're paying every month goes up, which means they cause the renters to pay more. Airbnb is now back in service. People are opening up their doors, so Airbnb is making a ton. I have friends that have one house that they do Airbnb, and they're making 10 grand a month from that one house, and it's not even in a very huge city. It's not a city that you would think, oh, it's got Disneyland next door or something like that. So you want to take advantage of this. Guys, I hope that this information has really helped you. If you have information that you want to share, put it in the comments down below. Reach out to me through my website at www.watchbob.youtube.com, or you can always find me at the Hive at hive.blog/BobTheBuilder2, because I'm Bob the Builder. And if you have any questions, reach out. Thanks guys for watching, and we'll see you next time. Thanks.